And welcome back. Markets are pointing to a steep sell-off at the open. As you can see, the Dow was down 338 in the pre-market. This comes as a survey of U.S.-based CEOs shows that recession fears top their list of concerns heading into the new year based on lingering concerns about global growth and the completion of a China trade deal. Let's bring in Mainstay Capital Management CEO and Chief Investment Strategist David Kudla. Hey, David, and Happy New Year.
Happy New Year.
So are you worried about a recession in 2020? First quarter, second quarter?
Certainly not worried in the first quarter, not even worried in the second quarter. We had fears last year about a recession that never materialized. I'd say some people had fears about a recession. We didn't. That didn't materialize. There was a concern about the yield curve inverting. There were concerns about economic data just a few months ago that has been improving. We've got now trade deals that we're making headway on, economic data improving. And if we look ahead into the next few quarters, we think that we've got growth ahead of us for the U.S. economy, not a recession. And
to your point, and Ryan, I'll bring you into this as well, is that we actually saw the 10-year, the yields actually were dropping and prices were spiking. A little bit of flight to safety, too, with gold. So.
Yeah, I'm not sure. I mean, the yield, we're at 1.8 on the 10-year Treasury, which is a little bit higher than it was last year, which, what do you think about interest rates this year? Even though, the economy is strong, I agree with you, I'm wildly bullish. I'm in the same camp as you, but what do you think about interest rates? Could they go up a little bit this year?
I think it depends. We're right there at that, at the point where, we've got, with the improvement in economic data, we could see yields rise a little bit. Our forecast is for yields to stay about where they are, maybe come down slightly. The concern is that if the economy does start to heat up, we'd see rates, or the economy strengthens, we'd see rates pick up a little bit.
Which may not be a bad thing.
Which may not be a bad thing.
Can I just add as a rejoinder to that, though, are you concerned at all about the levels of debt we see at the corporate level?
There's certainly concern when we're looking at high yield, right? Looking at credit, where we've come down to on spreads, where spreads have tightened to. I think there's some concern about high yield now. Coming into 2019, high yield was an area where there was money to be made. Now those spreads have tightened a lot. We're a little bit more leery about high yield coming into 2020, high yield bonds, high yield corporate bonds. So I'd be careful there.
And James, you and I were talking earlier this week about government debt. Federal debt, which I'm not sure is being talked about enough right now.
No, probably not. Does this worry you? Is this like is it a long-term thing we should be worried about for the long-term future, or is this a question that's related to the upcoming economy in terms of what, 23 trillion is kind of a lot?
Yeah, I remember a vice president once that said deficits don't matter. And that long-term debt maybe doesn't matter, but we know that it matters, right? At some point, it catches up with us. But what we've seen is we've continued to add to the debt, add to the debt, add to the debt. We know that at some point it catches up to us.
We've had a strong start to 2020 up until today, but yesterday you had every major index actually closed in record territory, and you had an amazing month for December for the year, for the decade. I mean, we're riding this bull market for 10 years, but obviously the concern for the average person out there is, when's the bull market run going to end? And sometimes pullbacks can be healthy.
Yeah, the pullbacks can be healthy. We had last year, believe it or not, the biggest pullback we had last year was 6.8%. On average, it's about a 14% pullback each year. And we always say pullbacks are healthy. It's healthy to have that correction. It hurts when it's happening, but it's healthy for a bull market to have that pullback. But bull markets don't need to die of old age. They die because of an oil shock. We're getting a little bit of that now. They die of a spike in interest rates. We're not really forecasting that. There are these reasons that bull markets die, and right now, when we look at the economy, we look at fundamentals, and really our thesis is it's the Fed injecting all this liquidity into the system and other central banks around the world that's really pushing, we're looking beyond the fundamentals. It's the Fed and central banks injecting all this liquidity into the system that's pushing stocks higher.
At some point that might have to end, but we don't know we don't think it's in 2020 from what you're telling me, at least in the first half of the year. So that's good. It's bullish. I like that. All right. David Kudla, thank you very much for being here.
Thank you.